Economic ramifications for the shipping industry, analyzing a projected 15% increase in shipping insurance premiums by Q1 2025. Overview. As geopolitical tensions escalate globally, particularly in vital maritime regions, the shipping industry is poised to face significant economic challenges. A projected 15% increase in shipping insurance premiums by the first quarter of 2025 is anticipated as a direct consequence of heightened military presence in key shipping lanes, notably in the South China Sea and the Strait of Hormuz. This report synthesizes the implications of this increase, delving into its potential impact on operational costs, shipping rates, global trade dynamics, and risk management strategies within the industry. Key impacts on the shipping industry. 1. Increased insurance costs. The shipping industry relies heavily on insurance to mitigate risks associated with maritime operations. With the anticipated rise in insurance premiums, shipping companies will bear significantly higher operational costs. The increase stems from the need for underwriters to account for elevated risks linked to military activities and geopolitical tensions. This change will likely lead to tighter profit margins for shipping companies, necessitating adjustments in their financial planning. 2. Impact on shipping rates. In response to rising insurance costs, shipping companies may be compelled to raise freight rates to maintain profitability. This shift is expected to have a cascading effect on consumer prices worldwide, as increased shipping costs may translate into higher prices for goods. The potential for inflationary pressures in various economies could arise from the combined effects of increased shipping rates and existing supply chain disruptions. 3. Risk assessment changes. To combat the financial impact of surging insurance premiums, shipping companies will likely need to re-evaluate their risk management strategies. This could include diversifying shipping routes to minimize exposure to high-risk areas, implementing enhanced security measures, or investing in advanced technology for better risk assessment and management. Companies may also consider forming alliances or partnerships to share risks and costs associated with maritime operations. 4. Global trade dynamics. The projected increase in shipping insurance premiums may lead to shifts in global trade patterns. Companies might avoid high-risk maritime routes, opting instead for alternative paths that may be longer but perceived as safer. Such a change could disrupt established shipping lanes, impacting economies that rely heavily on maritime trade. Countries dependent on specific trade routes may need to adapt quickly to maintain their economic stability. Timeline of events. 2022, the geopolitical landscape begins to shift, with rising military presence in critical shipping lanes prompting concerns within the shipping industry. 2023, analysts and industry experts start forecasting an increase in shipping insurance premiums driven by the escalating risks associated with maritime operations. 2024, initial reports of higher insurance costs begin to surface, prompting shipping companies to reassess their operational strategies and risk management approaches. Q1 2025, the projected 15% increase in shipping insurance premiums is expected to take effect, coinciding with adjustments in freight rates and potential changes in global trade routes. Variability among sources. While there is consensus on the projected increase in insurance premiums and its likely repercussions, different sources offer varying perspectives on the specifics. Some focus on the immediate effects on freight rates and consumer prices, whereas others analyze the broader implications for the shipping industry and global trade. Some reports provide quantitative projections and case studies to illustrate potential outcomes, while others rely on expert opinions and qualitative analyses. Conclusion. The anticipated increase in shipping insurance premiums due to heightened military presence poses significant challenges for the shipping industry. As companies confront rising operational costs and potential shifts in trade dynamics, they must also adapt their risk management strategies to navigate this evolving landscape. The broader impact on global trade and consumer prices will require careful monitoring as the geopolitical situation unfolds. Ultimately, the shipping industry's ability to remain resilient and adaptable will be crucial in sustaining its vital role in the global economy amidst these changes. The analysis of the projected 15% increase in shipping insurance premiums due to heightened military presence in maritime regions reveals several counterintuitive implications for the shipping industry and global trade dynamics. Counterintuitive insights. 1. Increased security may lead to greater risk. While one might expect that a heightened military presence would ensure safer shipping routes, the reality is that increased military activities can heighten tensions and lead to more confrontations. This paradox suggests that the very measures taken to secure shipping lanes may inadvertently create a more volatile environment, leading to higher insurance premiums. As shipping companies perceive greater risks, they face a dilemma: invest in security or accept escalating costs. 2. Passing costs versus absorbing costs. It might seem logical for shipping companies to pass the increased insurance costs onto consumers through higher freight rates. However, many companies may choose to absorb these costs initially to maintain competitive pricing and avoid losing market share. This could lead to tighter profit margins and financial strain on shipping companies, which may not be sustainable in the long term. The decision to absorb costs versus passing them on can also vary significantly by region and market conditions. 3. Shift in trade dynamics could benefit some regions. A shift away from high-risk areas due to increased insurance costs might seem detrimental for regions heavily reliant on maritime trade such as Southeast Asia or the Middle East. However, this shift could inadvertently benefit safer regions that are less affected by geopolitical tensions. For instance, trade routes through the Arctic or along the coasts of North America may see increased activity as companies seek to avoid riskier paths. This counterintuitive outcome could create economic opportunities for regions that are perceived as safer, leading to a reallocation of global trade flows. For impact on smaller shipping companies, the anticipated increase in insurance premiums may disproportionately impact smaller shipping companies that lack the financial resilience of larger firms. While larger companies may have the capacity to absorb increased costs or negotiate better terms, smaller firms may struggle to remain competitive. This could lead to market consolidation where larger companies acquire smaller ones, counterintuitively reducing competition in the industry. 5. Potential for increased innovation. The pressure of rising costs could spur innovation in the shipping industry. Companies might invest in new technologies or logistics solutions to improve efficiency and reduce overall costs. This could include adopting blockchain for better supply chain transparency or using artificial intelligence for optimized routing. While the immediate effect of rising insurance premiums is negative, the long-term impact could be a more resilient and technologically advanced shipping industry. 6. Inflationary pressures may be mitigated by global supply chain adjustments. It is often assumed that higher shipping costs lead directly to inflationary pressures in consumer goods prices. However, if companies effectively adapt by diversifying their supply chains, sourcing materials closer to manufacturing sites, or utilizing alternative transport methods, the inflationary impact on consumer prices could be less severe than anticipated. This counterintuitive dynamic highlights the adaptability of markets in response to economic pressures. 7. Geopolitical factors could lead to unexpected alliances. The rise in military presence and associated insurance costs may drive companies to seek alliances with firms in politically stable regions. This could foster unexpected partnerships that reshape the shipping landscape. For example, a shipping company in a high-risk area might form an alliance with a company in a stable region, leading to collaborative efforts that mitigate risk. This could lead to new business models and cooperative strategies that were not previously considered viable. Conclusion. The projected increase in shipping insurance premiums due to heightened military presence presents various counterintuitive economic ramifications. From the paradox of increased security leading to greater perceived risk to the potential for innovation arising from financial pressures, the shipping industry faces a complex landscape. While the immediate effects may be challenging, the long-term outcomes could reshape global trade dynamics and market structures in unforeseen ways. As the situation develops, stakeholders will need to remain agile and responsive to navigate these economic challenges effectively. The report on the projected 15% increase in shipping insurance premiums due to heightened military presence in key maritime regions by Q1 2025 reveals several critical aspects that are often overlooked but carry significant implications for the shipping industry and global economy. Below are some important content points that may not receive the attention they deserve. 1. Regional specificity of geopolitical tensions. While many discussions focus on broad geopolitical tensions, the report highlights specific regions such as the South China Sea and the Strait of Hormuz. The significance of this specificity lies in how it can lead to localized impacts on shipping routes. For instance, increased military activity in these regions could lead to rerouted shipping lanes, which might not only increase transit times but also alter shipping schedules. Companies that fail to adapt to these changes may find themselves at a competitive disadvantage. 2. Long-term strategic planning. The report emphasizes the need for shipping companies to re-evaluate their risk assessments and adapt their strategies. However, the significance of long-term strategic planning often gets overlooked. Short-term cost adjustments might be prioritized, but companies must consider long-term implications such as investment in security infrastructure, insurance diversification, and the potential need for partnerships with military or governmental entities for safer passage. A lack of foresight could lead to significant losses in the future. 3. Consumer behavior and price sensitivity. The anticipated increase in freight rates due to rising insurance costs has direct implications for consumers. While it is commonly understood that prices for goods will rise, the nuanced impact on consumer behavior is often underestimated. For example, consumers may alter their purchasing habits based on price increases, leading to shifts in demand for certain goods. This behavioral change could have cascading effects on supply chains and inventory management, which are critical for businesses relying on just-in-time inventory systems. 4. Economic ripple effects. The report mentions inflation as a potential consequence of rising shipping costs, but the broader economic ripple effects are significant and often overlooked. Increased shipping costs can lead to higher prices across various sectors, not just consumer goods. Industries such as construction technology and agriculture, which rely heavily on timely shipping of materials and products, may experience increased operational costs, affecting their profitability and in turn the overall economy. These interconnected ramifications highlight the systemic risk posed by increased shipping insurance premiums. 5. Environmental considerations. While the report primarily focuses on economic implications, the environmental considerations of rerouting shipping lanes in response to geopolitical tensions are significant. Changes in shipping routes could lead to longer transit times and increased fuel consumption, which would contribute to higher carbon emissions. The shipping industry has been under increasing pressure to reduce its environmental impact, and any increase in emissions due to heightened military presence and resulting operational adjustments could draw regulatory scrutiny and affect public perception. 6. Technological investments. The report suggests that shipping companies may need to invest in technology for better risk management. Yet the potential for technological advancement is often understated. Companies could leverage data analytics, AI, and blockchain technology to improve supply chain visibility and enhance security protocols. The financial implications of such investments are crucial. While they may incur upfront costs, the long-term savings and risk mitigation they provide could outweigh these initial investments. 7. Insurance market dynamics. An increase in shipping insurance premiums due to heightened risks presents a unique opportunity for insurers as well. The dynamics of the insurance market could shift, leading to new products designed to address the specific risks associated with geopolitical tensions. However, this also poses a challenge for insurers. as they must accurately assess and price these risks without alienating clients through excessively high premiums. The delicate balance between offering comprehensive coverage and maintaining affordability is a significant concern that impacts both insurers and shippers. 8. Regulatory implications. The potential increase in shipping insurance premiums may prompt regulatory responses from government entities focused on maintaining trade fluidity. Policymakers may need to consider measures to stabilize the shipping industry, such as subsidies or tariffs that could influence insurance costs. However, these interventions can also lead to unintended consequences such as trade disputes or misallocation of resources, which could further complicate the landscape for shipping companies. 9. Impact on emerging markets. The report touches upon shifts in global trade dynamics but does not thoroughly explore the impact on emerging markets that rely heavily on maritime trade. Countries that depend on shipping for exports may find themselves particularly vulnerable to increased costs, which could hinder their economic growth and development. The long-term implications for emerging economies, including potential increases in poverty or reduced access to goods, are significant and deserve greater attention. 10. Insurance dependency and risk management. Finally, the report emphasizes the need for shipping companies to adapt their risk management strategies in light of increased premiums. However, the inherent dependency on insurance as a risk management tool can lead to complacency. Companies may rely too heavily on insurance to mitigate risks rather than proactively implementing comprehensive risk management frameworks. This dependency can create vulnerabilities that are exposed in times of crisis, highlighting the importance of a balanced approach to risk management. Conclusion. The anticipated 15% increase in shipping insurance premiums due to heightened military presence carries far-reaching implications that extend beyond immediate cost concerns. The nuanced interactions between geopolitical tensions, consumer behavior, environmental impacts, technological advancements, and regulatory responses create a complex web of challenges and opportunities for the shipping industry. As stakeholders navigate these changes, a comprehensive understanding of these often overlooked aspects will be crucial for sustainable growth and resilience in an increasingly volatile global environment. 1. Increased insurance costs. The projected 15% rise in shipping insurance premiums is primarily due to escalating geopolitical tensions and military activities in critical maritime regions. This increase signifies a direct impact on the operational costs for shipping companies, as insurance represents a fundamental aspect of maritime logistics. An in-depth analysis of how these rising premiums will affect various stakeholders in the shipping industry, including small shipping firms versus large multinational corporations, could provide insights into the broader economic implications. 2. Impact on shipping rates. As shipping companies are likely to transfer the increased insurance costs to consumers, there will be a consequential rise in freight rates. This could lead to higher prices for goods worldwide, impacting supply chains and potentially fueling inflation. A discussion on the elasticity of demand for shipping services and consumer goods, along with an examination of historical precedents where similar increases occurred, would enrich understanding of the potential economic fallout. 3. Risk assessment changes. The need for the shipping industry to re-evaluate risk assessments in light of the increased premiums is crucial. Companies may need to adopt new strategies such as diversifying shipping routes or enhancing security measures to mitigate financial risks. An analysis of how these adaptive strategies could influence operational efficiencies and long-term viability in the industry could provide valuable insights into the future of maritime logistics. 4. Global trade dynamics. The anticipated increase in shipping insurance premiums may catalyze shifts in global trade patterns as companies look to avoid high-risk areas. This could disrupt established shipping lanes with significant repercussions for economies reliant on maritime trade. A thorough examination of the potential reconfiguration of global trade routes and the socio-economic impacts on countries dependent on these trade networks would be vital for understanding the full scope of the situation. 1. Suez Canal Crisis 1956. the Suez Canal crisis was a pivotal moment in shipping history that had profound economic ramifications. The nationalization of the canal by Egyptian President Gamal Abdel Nasser led to a military intervention by Britain, France, and Israel. The crisis resulted in a major disruption of shipping routes as the canal was a crucial passage for oil and goods to Europe. Insurance premiums for ships transiting the canal skyrocketed due to the increased risk, greatly impacting shipping rates and operational costs. The crisis highlighted the vulnerability of maritime trade routes to geopolitical tensions and led to long-term changes in global trade patterns. 2. Iran-Iraq War 1980 to 1988. During the Iran-Iraq War, the Persian Gulf became a highly contested area with significant implications for global shipping. The conflict led to increased military presence in the region and frequent attacks on commercial shipping vessels. As a result, shipping insurance premiums surged and many shipping companies opted to reroute their vessels to avoid the Gulf. The war caused disruptions in oil supplies and contributed to fluctuations in oil prices, affecting not just the shipping industry but the global economy as a whole. This period underscored the impact of military conflicts on maritime trade and the importance of risk management in shipping operations. 3. Piracy off the coast of Somalia 2000s. The rise of piracy off the coast of Somalia during the early 2000s marked a significant challenge for the shipping industry. Increased piracy led to a drastic rise in shipping insurance premiums as companies faced heightened risks while navigating through the Gulf of Aden and the Indian Ocean. In response, shipping companies implemented various security measures, including hiring armed escorts and altering routes, which contributed to increased operational costs. The situation prompted international naval coalitions to combat piracy, highlighting how security threats can disrupt maritime trade and lead to broader economic consequences. The long-term implications included changes in shipping routes and an increased focus on maritime security. Future outlook: economic ramifications for the shipping industry from increased insurance premiums. As we approach Q1 2025, the projected 15% increase in shipping insurance premiums due to heightened military presence in critical maritime regions will have far-reaching economic ramifications for the shipping industry and global trade. Below, we explore key predictions regarding these impacts. 1. Operational cost adjustments. Shipping companies will face a significant increase in operational costs due to higher insurance premiums. This rise is expected to lead to a re-evaluation of budgets and financial strategies. Companies may be compelled to either absorb the costs, which could lead to reduced profit margins, or pass these costs on to consumers, resulting in increased freight rates. Prediction: by mid-2025, we may see shipping rates increase by approximately 10 to 15% as companies adjust to the new insurance landscape. This could contribute to inflationary pressures on consumer goods globally, particularly in markets heavily reliant on imported products. 2. Consumer prices and inflation. The ripple effect of increased shipping costs will likely extend to consumer prices. As shipping companies pass on the costs of heightened insurance premiums, retailers and manufacturers may increase prices to maintain margins. Prediction: by the end of 2025, inflation rates in various economies, especially in developing nations that rely on imported goods, could rise by 1 to 3% due to these logistics-related price increases. This will particularly affect essential goods, thus straining household budgets. 3. Shifts in global trade patterns. With the increased risk associated with shipping through volatile regions, companies may opt to reroute their shipping lanes. This could lead to a shift where companies avoid certain high-risk areas, seeking alternative routes that may be longer but perceived as safer. Prediction: by 2026, we could see a notable reconfiguration of global shipping routes, with a 20% increase in traffic through less risky corridors such as the Northern Sea Route and alternative trade routes in Africa. This shift could disrupt established trading relationships and affect economies dependent on traditional shipping lanes. 4. Investment in technology and security measures. To mitigate the financial exposure from rising premiums, shipping companies will likely invest in advanced technologies for risk management and enhanced security measures. This may include adopting more sophisticated tracking systems, cybersecurity defenses, and improved vessel security protocols. Prediction: by 2027, investment in maritime technology could increase by 25% as companies seek to bolster their defenses against geopolitical risks. This could lead to innovations that enhance efficiency and safety in shipping operations. 5. Impact on smaller shipping firms. Smaller shipping companies, which may lack the financial resources to absorb increased costs, will face significant challenges. Their ability to compete with larger firms that can better manage these costs through economies of scale may be impaired. Prediction: by 2025, we could witness a consolidation in the shipping industry, with smaller firms either merging with larger companies or exiting the market, leading to a 10 to 15% reduction in the number of active shipping firms by 2027. This could decrease competition and lead to higher prices for consumers in the long run. 6. Regulatory changes and compliance costs. As insurance premiums rise, there may be increased regulatory scrutiny surrounding maritime operations. Governments might impose new compliance requirements related to shipping safety and security, which could further raise operational costs. Prediction: by 2026, additional compliance costs related to new regulations could add another 5% to operational costs for shipping companies, compounding the financial pressures already felt from increased insurance premiums. 7. Geopolitical considerations. The ongoing geopolitical tensions that are driving up insurance premiums are unlikely to abate significantly in the near term. As military presence in strategic maritime areas remains high, the shipping industry will continue to operate in an uncertain environment. Prediction: by 2028, sustained geopolitical tensions could lead to a permanent adjustment in shipping insurance models, with premiums remaining elevated compared to pre-2023 levels. This could necessitate a long-term strategic shift in how shipping companies manage risks. Conclusion: the projected increase in shipping insurance premiums due to heightened military presence will have profound implications for the shipping industry and the broader global economy. From rising costs and shifts in trade patterns to increased investment in technology, the landscape of maritime trade is set to change significantly by 2025 and beyond. Stakeholders in the shipping industry must remain vigilant and adaptable to navigate these evolving challenges, ensuring their operations remain sustainable in an increasingly complex geopolitical environment.